Good morning, good afternoon, good evening to you. Thank you for attending this session titled Trading Opportunities in Low Volatility Markets. My name is Brian Kahn. You have my email there if you're interested or in contact me via so you can get any of your questions answered if there are some lingering through. That being said, please go ahead and type in your questions as you have them, and I will try and make sure that I get to them during tonight's session. Everything as far as commentary that I post will get sent over to IBFX's Daily Forex Trading Edge page. So that is the website for my regular market commentary. I did not post one today, but I did post one yesterday that talked about some of the market activity today. So make sure that you do read it if you didn't catch up on it already. First things first, we'll go through this disclaimer. I'll let you read it, and I'll just leave it up here for a few moments. And again, everything I talk about tonight is for educational purposes only. No buy, hold, or sell recommendations. Make sure that you understand what and why you're doing with a trading plan with the proper amount of risk for your specific situation. Outline, I always like to tell you where we're going. Fundamental analysis first, because I think it's pretty important. We'll talk about some macro and micro events. Technical analysis, that's going into the charts. We'll use various platforms for that. Obviously, we'll use the IBFX MetaTrader 4 platform. Then we'll talk about the meat of tonight's subject, which is low volatility, equity and volatility relationship. So equity market and volatility relationship. If there's trading ranges out there, maybe talk a little bit about trading frequency and when will this lower volatility period end. And then we'll go ahead and do a review and make sure that we tackle all of those questions. Okay, so fundamental analysis first, a quick discussion of current events and what they mean for traders and investors. I wrote about this kind of quandary that we're in right now as far as expecting central banks to bail out the markets, and the central banks did bail out the markets around the world in September, but now that's passed. And now what's going to happen going forward, because we know that they are not going to probably act too quickly. They're going to wait and see what economic data is like. So you need to be paying attention to economic data, because now we're paying attention to post-economic data, meaning post-quantitative easing economic data. So that's what we're going to look at today as far as going into the economic calendar, which is provided by your broker, and they link it right to forexfactory.com, and I have it already pulled up. We'll go there. Other ways of staying involved are the television, CNBC, or some form of that. Bloomberg, which is a television station, also has a great internet site, and then obviously other market sites. So let's leave this very quickly, and I'll pause as we switch over to the economic calendar. This economic calendar, you have to take it with a grain of salt, because the economic data has not been driving the equity markets. It hasn't been driving the financial markets really as far as direction goes, because it's taking a back seat to the central banks and the major international intervention around there coming from the Federal Reserve in the U.S., ECB in Europe, Bank of England, Bank of Japan, wherever it may be. Those are really the influence. So when those people talk, we listen. Today, we had ECB President Draghi speaks. If you're not sure what he said and you want to review it, then you can go ahead and click on the open detail and then go down to a story on it. But that's how you want to be using this page, is not going and saying what happened, why did that move, why was I caught off by surprise, but doing this before. Every Sunday night, you should be sitting down and doing your work and saying, what are the important events that I need to pay attention to depending when I'm trading. Everybody I'm talking to tonight is in different parts of the world. You're trading different currencies, different time frames, so this matters differently to you. You've got to filter it out. What does it mean for you? Are you a short-term trader? Are you a long-term trader? What does it mean for you? Here, a Swiss National Bank Chairman, Jordan, speaks. Overall, the economic data is pretty light this week for around the world, but we still have these speakers that we want to know what they're saying, because they're setting the tone for policy, interest rate policy mostly, and we are trading interest rates through foreign currencies, obviously. But keep your eye on the economic data. What's it doing? Because now that we are post-quantitative easing in various regions of the world, is the data coming in so poor that that's going to get the equity markets to move down and change volatility and change what's been happening in the past? Because recently, the equity markets have been doing nothing but going up. So segueing from this back into the slides very quickly. Okay, so fundamental analysis we're covering, but technical analysis, what are the traders doing with this news? We want to start to look at trends and support and resistance and intermarket relationships. So I'm going to do this as this is the meat of our subject, so I'm not going to go there just yet. I'm going to go to the next slide. I want you to be aware of the equity and volatility gauge relationships. What are equity markets doing? They've been in an uptrend. But that's because they were hoping for quantitative easing. They got it. Now, what is economic data doing and what are the markets doing now? Also something to be aware of on that economic calendar, earnings. We get 4 sets of earnings per year in the United States for our big companies, multinational companies, for all companies, but obviously the biggest ones we're paying attention to because they can affect the market. So today Alcoa went, and these are big, that's a big aluminum manufacturer all around the world. So we want to pay attention to, are these companies making money? If they're not making as much money, what does that mean? Are they going to lay off? And what does that mean for the economy going forward? So we want to pay attention to an earnings period right now. So that's an extra part of the economic calendar that you've got to be aware of that doesn't show up on the economic calendar. That shows up if you're a stock trader, option trader, if you're following the equity markets and paying attention to equity earnings. So we want to see what the equity markets are doing, what that means for volatility, and then what that means for trading going forward. And I said trading ranges there, and I think that you'll see what I mean in just a moment. And I'm just checking to see questions before I go ahead and move to the next application. So let's go look at equity markets, let's go look at volatility, and then we'll go into foreign currencies from there. So here we are in IBFX's sister company. This is TradeStation, and I'm going to bring up SPY, which is the ETF representing the stock market. So here you have an uptrend. This is a daily chart, so we're seeing the entire year, October of last year through October of this year. And in equities, we pay attention to the percentages, 110 last year, and now we're at 145 this year. That's a pretty big move up. $35 move of a $110 stock is only 31% in the year. Not bad for the stock market given what's going on around the world, and it's been buoyed obviously because economic data is bad, and obviously central banks are intervening. But as of late, if we shrink this down a little bit, okay, and we go to a smaller time frame, this is what's happening just in the past couple weeks. We topped out here, we came down, we came back up, and anybody out there who's paying attention to chart patterns, if you know what an M pattern is, or a double top, one top here, here's your neckline right here. Could we break it and then go down lower? So this is the first time we're seeing a pretty decent sell-off, besides this one that we ran back up on. But since we've had a couple weeks since the quantitative easing, now we're starting to see economic data come in, and now we're starting to see that it's continuing to underperform. And if we don't get this quantitative easing soon, maybe we have some room to go down. Because if you look back to earlier this summer, this is when economic data around the world started to slow down in April and May and June. And the market went from 142 down to the 120 area, 127. So it broke about 10%. All right. Now we ran up because we were hoping for quantitative easing, but in this run-up, economic data is getting worse. Now we had quantitative easing right here on the 13th. Now we have a couple weeks of data that's still not getting, better and getting worse. And now we have earnings period. And if that earnings period gets worse, a couple weeks, a couple months later, could we start to break in the equity markets? We'll be watching this pattern. Another pattern to keep an eye on is this old support and new resistance. I'm going to go ahead and draw a trend line right on here. All right. And here we go. Something like this. Okay. Look where we are right now. Here's resistance, 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 support. and it blasts off support, and it came right back down, and we're sitting right here in the S&P on support right now. A lot of people want this to break and want it to close below it. So some people may have drawn the trend line a little bit differently, so it might have already closed below it. But that's a pretty crucial area. And then you have support here at 143, and below that you're heading down to the 140 level. All right. So keep your eye on this line over the 140 to 144 area. And again, this is 10% of the value of the S&P 500. So the 1430, 1440 area, if that breaks, we might head down to 1400. Maybe that's a buying opportunity. Who knows? Because maybe we're oversold. Nobody knows. But keep your eye on this to see what happens at this old resistance, new support line. Okay. Overall volatility, and we're talking about volatility. What has volatility been doing? This is a long-term chart. 2008, 2009, it went down. 2010, we had a little brief period of volatility. It went down. 2011, a brief period of volatility. It went down. 2012, a very, very small, low period of volatility. When volatility goes down, trading ranges become smaller. Trading conviction becomes less. People are trading for less amount of moves. All right, so your movement, the size of moves are smaller as volatility goes down. If any of you keep an eye on support, look what's happening down here at this level, right down where we are right now, as it bounces off the 1350, 14 area and heads back up. To see that on a smaller time frame, there we are. There's that 13.5 level, and look what we did. Percentage-wise, 13.5 up to 16.5 in a few days, in a week. Not bad. A $3 move of a $13.5 stock. 22% isn't bad. It's bouncing off that support line. We use stops because there are no guarantees. It could go lower. If the stock market turns around and goes higher, volatility could turn around and go lower, and there's nothing to say that it can't go below 13, 12, 11, 10, 9 as the stock market goes 13,000, 14,000, 15,000, 16,000, 17,000. That may happen. Quantitative easing could drive that. Fundamentals recovering around the world could drive that. But the bottom line is, as equity markets go higher, volatility goes lower. Volatility translates into our trading frequency and trading ranges. So keep in mind that volatility was a lot higher back in 2008 and 9, and then it was very high in 2010 in the summertime. 2011 summertime, this is when Greece was going on, 2010 and 2011, and even 2012, we got periods of higher volatility. So if you look at Forex now, and we switch over to Forex, and we switch platforms, let's pull up the pound versus the US dollar, okay? So look at the trading ranges. Look at the trading ranges back in 2008 and 9. Look how big these bars are, okay? And then things started to settle down in 2009, and look how the bars are smaller. And then we had a little bit more volatility, and then overall bars are smaller. And look now, look at these bars right here, right now. So volatility is as low as it's been in the past couple months until just a week ago or two, but look how small these bars are. And again, this is summertime, and so there's some seasonalities, but higher volatility back in 2008 and early 2009, big daily bars, and we're looking out a weekly, so big weekly bars. Volatility goes down, equity markets go up, smaller weekly bars. And as volatility goes down, again, you can see here was probably a higher period of volatility. Here's a lower period of volatility. Bars are very small, we're in a range. But look at this. Since 2010, 11, 12, the pound has been in a pretty tight range. So 152 to 165. So that's it, 13, 14, pennies right there. That's the range. That's been it. And look, we're right back at the top of it just a few days ago, and we bounced off it. Here's a daily chart. We ran up, equity markets went up, the pound ran up, hit resistance, and backed right back down. So equity markets are going down, the pound is going down. That's a relationship. So this is what I'm talking about by kind of trading in lower volatility markets. So let me pull up these slides so we can focus on this, and then we'll come back. What are equity markets doing? What's volatility doing? Build realistic trades in Forex given what's going on in these smaller range days, given how low volatility is. Trading ranges. I want to go over trading ranges for intraday traders, swing traders, and longer term traders. So here we go back into the platform, and look at this move right here. If you understand that we're kind of range bound, and you look at this chart, and you see this run up, so here's your longer term trader. Your longer term trader is probably taking advantage of these support and resistance areas right here. All right, support, support, and support, and maybe they're using that. Resistance, resistance, resistance. So there's your range right there for a longer term trader, oscillating back and forth. Then you bring it down from a weekly chart down to a daily chart, and maybe the short term trader, a swing or day trader, they can get short right here at resistance. They put their risk at 10 or 15 pips, and they make 20 or 30 pips as it goes their way. The longer-term trader risks 50, 80, 100, 200 pips, and they try and make 100, 200, 300, 400 pips as it goes down. Just depends on who you are, what you're going for, how big your risk tolerance is due to how big your account size is, what you can risk. I kind of segment it. People with $10,000 accounts and smaller are probably going to be short-term day traders, maybe swing traders. People with larger accounts, 10,000 plus, can be longer-term traders, and they might even use the Forex markets to be what I call intermarket hedging, so that they can hedge a commodity position or an equity position. Remember, I don't just trade short-term Forex, that's my bread and butter, but I trade longer-term Forex because I'm always paying attention to the trends in equity markets and using options for different types of strategies. And so I use these intermarket relationships because I'm managing portfolios and doing trades of different time frames and different lengths with different size for different reasons, all right? And I'm comfortable with that. Not all of you may be comfortable with that, so you may be starting out and saying, I'm just a short-term trader, I'm just a swing trader, I'm just an intraday trader, I'm just a longer-term trader. But you're seeing some opportunities here that the charts, base it off of the charts. The charts are telling us what's going on. If I want to bring it really down to a short-term trader, here's my 15-minute chart that a short-term intraday scalper might be paying attention to. And you can see that we had a pretty, again, you don't trade 24 hours a day. So here's the Asian session. Here's the morning session, GMT time, 7 o'clock, 8 o'clock, 9 o'clock, 10 o'clock, and had some activity. And then all of a sudden the equity markets open up. What did the equity markets in the U.S. do? They went down all day today. What did the Forex pair do? The United States dollar strengthened against the pound. The pound went down today against the U.S. dollar and then kind of flattened out towards the end of the day. What did the euro do in the same time frame? Well, equity markets went down. Here's the U.S. Open as far as our equity markets. Euro goes down and then sideways. So the U.S. dollar strengthened against currencies today. What did it do against the Aussie dollar? Today, it was kind of sideways. The Aussie dollar was down though. You know, here's that big move down, and then it recovered a little bit. So commodities, maybe the commodity currency, maybe the Australian dollar, their currency might be doing a little bit better today given what's going on fundamentally and technically over there. But overall, it was down just a tad. The New Zealand dollar, and I can take off this Fibonacci for you so you can see it. Again, there's that same move. Equity markets take off to the downside in the U.S., and boom, there's the New Zealand dollar, big move down, sideways, big move down. So there's your trend down, small retracement. You can put your Fibonacci right here. There's a big move down, had a 38 to 50% retracement, and selling into that retracement was the way to go. It was a trend down, big move down, small move up, big move down, made a lower low. So getting short here and here and here was the right move, and then the stock market went lower, and then the New Zealand dollar broke out and went lower. Against another commodity currency, against the Canadian dollar. Here's your intraday range. What did the United States dollar do? It strengthened. There's the stock market opening, going down, and there's the United States dollar going up. But overall, these ranges, here's yesterday's range. So Tuesday, Monday, these ranges are 70, 80 pips. In high volatility, intraday ranges can be 150, 200 pips. We're just not getting that. We're getting 50 pip ranges, 70 pip ranges, 90 pip ranges, because volatility is still very, very low. So I want you as a trader to look at volatility and have the charts tell you what the ranges are and have the charts tell you what's achievable for the proper risk to reward. That's very, very important. Okay? Again, this is for you guys, so hopefully you're asking questions, and I'm looking back at the panel right now and seeing that not many are coming in. I'm talking fast. I'm going, through a lot of data. I hope it's making sense, but if not, please ask questions, because even though, and this is the point that I want to stress, even though there's low volatility, there's still opportunity going on. So what I want you to pay attention to is trading frequency. Trading ranges based on volatility, lower volatility, smaller ranges, dictate my frequency of trades, how often I trade. In lower volatility markets, I trade less. I don't expect to trade 3 or 4 times a day as a day trader. I might trade once or twice a week, and I'm okay with that because volatility says you better be okay with it, because if you overtrade, it can be deadly. Also, in lower volatility markets, sometimes we get one move and then sideways action, one move syndrome. So when will this period end? I'll answer that in just a moment. But what's one move syndrome? Look at the pound a day. If I'm trading during the United States session, the United States session starts right here. This is the opening of the equity market. We started at 60.20 and we went down to 59.76. So that's 45 pips. And after that move, we had a range of 15 pips, okay, for the rest of the day. So 15 pips, is that tradable? If you're trading large size and you're going for 5 or 6 pips, absolutely. But this was the bulk of the move, and then we went sideways. So that's what I mean by one move syndrome. That's what you get a lot. Yesterday, most of the move, here's yesterday, most of the move down happened, the big thrust of it happened in the Asian session, in the European session, and my day in the United States didn't start to right here. My day yesterday, a little bit less volatile today in the equity markets, 60.35 to 60.20, 15 pip range. If I overtrade that and say, I want 50 pips, I'm not going to get it because it's only moving 20 pips. I can't get 50 pips if it's only going up and down 20 pips. So I could go for 8 pips, and that's realistic. So the charts are telling me what to do on my time frame for what I trade, whether it's short-term or long-term. Use the charts to tell you that and help you. So a couple questions. Can you explain the IBFX volatility indicator? I've actually done a webinar on that, and I think that you should watch, and I think there's been some others on it. The volatility indicator kind of evens out the different currency pairs out there because some of them are different values based on their interest rates. And what it tells you is the trading range of those. So that if you kind of are looking at the pound and saying, hey, the trading range isn't great here, you can look at the volatility indicator to see maybe if there's a pair, an exotic pair that you're not used to trading, but it might have a larger trading range. So it just helps you compare trading ranges among pairs. But if you go to I'll show you the link. If you go to where I did a webinar on it, you can see it, and IBFX will be happy to help you if you have questions on it. Please take advantage of that great tool. So that's a good question. You guys take advantage of that new tool and put it on as part of one of your expert advisors. Low volatility market. Which market is the best to trade, Asian, Euro, or American? Generally, lower volatility means low volatility for every market, whether I'm a commodity trader, futures trader, option trader, stock trader, Forex trader. So volatility goes hand in hand across the markets. Most Forex traders aren't used to looking at volatility because it's more of an options tool. I trade options and I pay attention to it because it affects the pricing of my options. But I want you guys to use it because I think it can make you a better trader, a more realistic trader, and understand, hey, it's low volatility, smaller amount of pips I'm going for. Hey, more volatility, the trading ranges are bigger, I might trade more frequently, and I might have to cut my size back because the chances of it moving 50 pips are greater than when the volatility is low and it's only moving 8 or 10 or 15 pips. So you might trade larger size in these markets and smaller size in volatile markets. But across the time frames, I'm not really sure you're seeing much of a difference. I think it's all equal, that it's low volatility across all. So trading ranges in Asian markets, in low volatility markets versus high volatility markets, is the same ratio as it is in the Euro region, low to high. And keep in mind, if you can trade multiple, great. And you might have to stay in front of the markets longer to see more opportunity. But that doesn't mean that you'll necessarily trade just because you're sitting in front of the markets. It could be a dead day all across all time frames. Let the markets, let the technicals and fundamentals tell you. So that's a very good question. Where do you find the volatility indicator? It's in your expert advisors. Again, if you have any questions, I'll show you the link to my webinars where you can find it. But call IBFX. Remember, I'm a consultant and I do this education for them, so I'm not an IBFX employee. So I don't have it up here. And I don't think it's on this demo account anyways. It's on my live account. But just, give them a call, get on, the great customer service there and get on the phone with them and get them to help you install it if you don't have it installed. But like I said, it should be under the expert advisors. So go ahead and find it that way. But a very cool tool that they just developed because of these low volatility markets. So keep that in mind, that they're aware of it and they're trying to provide you with the education out there. When will this low period end? as far as I'm concerned, the volatility could stay low forever if the central banks around the world stay involved forever and they keep saying, we're here, we're here, we're here. We want the equity markets to go up. We don't want there to be volatility and fear, uncertainty and anxiety. So as far as I'm concerned, the technicals and the fundamentals will tell us when it's ending, and we'll see it and feel it as we pay attention to trading ranges. To review fundamental events, I gave you my opinion of kind of what I'm seeing out there. Technical analysis, we looked at the charts. We saw some long-term trends. We saw some long-term ranges. We saw some short-term trends and ranges. Trading low volatility markets, there is opportunity, but make sure you make it realistic to what's out there. Questions, we had some questions come through. A lot of them were about that volatility indicator, so make sure if you have questions about it, you reach out to IBFX. Next webinar, I'll be speaking to you in about 2 weeks with another fundamental analysis update, technical analysis update, and the main topic, swing trading using the hourly one chart. So we're going to be going through this lower volatility period, and I'm not a big fan of swing trading, but in these markets, I think you can take advantage of it because we're more range bound and you can hold on to trades a little bit longer because we're not getting tons and tons of volatility to shake you out of a swing trade. So I'll break down exactly what I think a swing trade is. So I'm going out of my, not necessarily comfort zone, but out of my normal trading zone to talk about swing trading. Education recordings, that's my